I guess I would be a little more cautious just because I got burned by PayPal, and I would want to see I would want to see I would want to see evidence that what the new CEO is trying to do is going to take effect, and you should start to see that sooner than later. In the next few quarters, you should start to see things start to turn around or improve.
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks. Welcome to Investing for Beginners podcast. Today, Andrew and I are going to talk about why are stocks crashing all over the place today. In the markets over the last couple of weeks, we have seen quite a few companies tank after earnings releases. And in some cases, legitimate. In some cases, maybe not. And so we thought we would pick out some of the companies and that have been exposed, shall we say, and talk about why we think some of those reasons are happening and maybe how you as an investor can kind of think about it and react to these positive or negative news that you're seeing on CNBC, for example. So with that, maybe we should start with a company. Why don't we start with one that I'm familiar with that most people probably have never heard of, and that would be Fiserv. So yes. What do you know about Fiserv?
Well, because you've presented to me multiple times talking about the company, I know it's in payments and I know it's part of that chain where you don't necessarily see it when you swipe your Visa card, but it is playing a big role behind the scenes. The stock was like crashing is almost an understatement. This was a big drop for a company of that size, right? Huge
drop. So those of you, which is probably most of you, are unfamiliar with Fiserv. The ticker for the company is FI, and it trades on the New York Stock Exchange. And so it recently dropped around 40%, maybe greater than 40% a couple days ago. And huge drop. The company, as Andrew said, is in payments. They have two, I guess, segments, if you will. They have a core banking segment, which is more their legacy product, and this has been around for a very long time. And what that does is they operate the behind the scenes banking tech stack for the big banks. So a company like JP Morgan, I'm not sure, I can't confirm that Fiserv is a JP Morgan client, but for a very big bank, what they do is they handle all the tech infrastructure. So when you go online to check your balances, that's what Fiserv is doing. When you go to see if you've made your payment on your loan, Fiserv is doing that. If you want to have online banking or an app through JP Morgan, then Fiserv would handle all of that. So that's really what they do. It's kind of the plumbing of banking. Very boring, but very necessary, been around for a long time. The other part of it is they have a payments processor called Clover, and they have some other smaller parts and pieces of that. But Clover competes directly against companies like Block, Toast, Adyen, Stripe. So they handle a lot of payments for merchants, generally small to medium-sized businesses. And they've been, this is a segment that they bought in 2017, I believe. And up until recently, it was doing very, very well. Now the company is tanking because, and I'm gonna take some numbers here from fiscal.ai. They have an AI summary that you can get on their earnings calls, and this could be very helpful. So for their quarter three adjusted revenue, they grew a blistering 1%. Their organic revenue for quarter three was a blistering 1%. Their merchant solutions, which is the Clover part of it, was a whopping 5%, and their financial solutions was negative 3%. So that combined with the fact that the company is going through a transition, and they gave really, really soft guidance for the rest of the year. Now, keep in mind, this company generally grows in the 8 to 10% range. It's very stable, steady. decent grower, but not a fast grower. And because it's dropped so much over the last, well, at least the last quarter, then the market reacted very violently to the bad news. And then because the market tends to be forward looking and they're coming out saying that we're not going to do very well for the rest of the year and into 2026, not great news for Fiserv.
Do you know off the top of your head, like that mix between the core banking and the payments? Like, are we talking 50-50? Is it kind of like 60-40?
Probably, it's probably closer to 60-40 now, with the merchant being bigger than the core bank payments. And that has been growing over the last few years. One of the things that management said in the earnings call is that they've been kind of banking on organic growth from places like Argentina, for example. And Argentina is, it's a very volatile place to operate. And so when that country struggles, then Fiserv is going to struggle, especially if they're, banking on, no pun intended, if they're banking on that being a big part of their organic growth story, then they're going to struggle. And the turnaround is kind of they have a new CEO. And so the old CEO was kind of like trying to put the company everywhere all the time. And the new guy is coming in, he's trying to kind of focus operations and cutting costs, trying to reduce where they're operating and try to focus more on the banking and the merchant solutions as opposed to trying to be everything for everyone. And they've also laid off people, and they're doing a lot of things that you normally do when you air quote are trying to turn around the business. And so the market just doesn't like any of that stuff. None of it was good news. It was probably necessary, but it wasn't good news at all.
What can investors glean from that? Is that a familiar story of a company tries to do too much and then fails at it and then needs kind of like a refocus?
For sure. This is definitely something that you see when, I guess you could probably call it empire building, where they're so focused on trying to build out the company that they forget why they were successful in the first place. And the company that immediately springs to mind and is going through the same kind of painful struggle is PayPal. A few years ago, PayPal was trying to be everything for everyone, everywhere. The all-in-one app that the then CEO, really aspired to get the company to. They really got away from what they were good at, which was the branded checkout and the PayPal button, which is what they're known for. They got away from that. And once that really started to take effect, then the company started hitting the skids. And they're still, the new CEO is doing a pretty good job and is trying to turn the Titanic around, so to speak. But it's going to be an uphill slog. And I fear that this will be the same impact that Fiserv will have. So when you start to see companies start to build beyond what their core competency is, or starting to try to become everything for everyone, I think that's a time where you probably got to, I think in a lot of cases, you got to be nervous about that. I would be anyway.
Yeah, me too. Do you know of good ways to try to avoid situations like that? Avoid buying these stocks where the businesses kind of lead up to this kind of a situation?
I think the way I would look at least the payments business, I think there's a couple things you could probably start to look at. Number one is if the company starts to expand beyond, if you start to see other segments about, sprout up and the company stops talking about their core product or what it is that they really do, if they start moving away from that, then that could be a sign that, hey, maybe the management is moving away from what got them here. This is the dance that brought them. Now all of a sudden they want to be a 3-point shooting team when they're all about defense and rebounding. It's not you start seeing them do that, that would be a concern. I think if you want to look at the numbers, I think there are probably three things you could probably look at that could start to give you some signs. If you see revenue starting to get sluggish or turn in the other direction consistently, if you start to see margins go the other way, that these new business lines that you're trying to go into are not as profitable. The other option would be, the other thing to look at would be the return on invested capital. If you start seeing that go the other way, when companies, some companies, when they go into the whole empire building idea, they start buying a lot of other businesses, and that generally pushes ROIC down. And so if you don't start seeing returns on those investments, then that could be a sign that maybe not great things are coming. And I think when you think about, those are probably the three things that leap to mind. Is there anything that you could think of that would be helpful?
No, I did want to talk about the ROIC because it makes me wonder, you talked about how they acquired Clover. And so is this the market reacting to maybe an overpay of Clover, even though it was so long ago? Or do you think it's something else?
And my outsider's thought would be that I think they're far enough removed from the acquisition of Clover that I think that's not really the issue. I think more of the issue is that they were spreading themselves too thin, and they were trying to put their, stake their flag in too many things all at once. And they were also doing some small acquisitions, and they were more focused on short-term goals to try to boost earnings and boost revenue. And in the long run, that's not great for the business. It's also not great for the shareholders. And when things, it's a fine line, right? It's like you want to do things to make your company improve, but sometimes you have to take the short-term pain for the long-term gain. And if you're constantly trying to do the short-term gains to keep the company moving, so it looks good, i.e. Jack Welch and GE all those years ago, beating every quarter, beating by a penny kind of thing, so manipulating the business and the financials so that it always looked good. Eventually that's going to catch up to you. And I think that's more what happened with Fiserv than the market reacting to an acquisition they made 7-8 years ago.
Yeah, it's totally fair. I'm curious, which, is it the core banking? Is it the payments? Is it just both? I mean, you mentioned 1% revenue growth for the entire company. So it sounds like both of their big pillars are failing at the same time, which is really strange because payments is growing fine, right? Across the rest of the industry.
Yeah, absolutely. Absolutely. I think some of it is, we were talking before we came on the air. I think some of it is, especially in the merchant solution side, I think I wouldn't say that these companies are eating their lunch, but they're probably certainly having an impact on their business. And that would be companies like Adyen, Stripe, Toast, PayPal, Shift4 Payments. Toast and Shift4 are very big in restaurants, especially smaller size restaurants, like small to medium sized businesses, you could say. And that's definitely where Clover is trying to play. And so that is probably having an impact on them for sure, because those companies are growing much faster than Fiserv and Clover have been. So I don't have any doubt in my mind that those companies are taking a bite of their pie for sure.
It makes me wonder, just like the broader restaurant industry in general, which we're going to talk about. So spoiler alert, but just, if you have, and I'm not saying that this is the case for McDonald's or Taco Bell or anything like that, but just to use them as examples, if you have the McDonald's and Taco Bells of the world as your clients, if Fiserv were to be the preferred vendor for Taco Bell and McDonald's, and then those vendors end up being disrupted by newer concepts like food trucks or, fill in the blank, does that contribute to a business like Fiserv falling too?
Yeah.
maybe hard to answer because we don't. Companies aren't always forefront with all of that information, but it just makes you wonder, like, is there are there other factors outside of all of this that we can't see that's also just putting, fuel to the fire of this dumpster fire kind of thing?
Yeah, absolutely. I think that's a very astute assessment, is that as other restaurants take share from other restaurants, it's just logical. If Taco John's, which is what, there was a chain called Taco John's I grew up with in the Midwest. If they're taking share from Taco Bell, then it would make sense. If Taco John's is under a different processor than Taco Bell, then Toast is taking part of Fiserv's share just because that restaurant is now doing more business. Cava is doing more business maybe than Chipotle. And so if they're have a different processor, then it would make sense that would tangentially, that processor would suffer too.
So what do you tell the value investor in you that sees Fiserv down 40% and price to earnings below 10? Like, is it a potential opportunity?
I mean, the deep value investor people are probably like, rubbing their hands together and like, licking their lips because they're like, woo. I guess I would be a little more cautious just because I got burned by PayPal, and I would want to see evidence that what the new CEO is trying to do is going to take effect. And you should start to see that sooner than later. In the next few quarters, you should start to see things start to turn around or improve. And it would also take me a few quarters to watch to see what, because the bottom line is where the business is now and where it's going. I wouldn't want to buy it. I own a share of Fiserv, and in all, transparency, my one whole share went from $100 and some dollars to $62. So, boo-hoo. But I have zero plans to add more to this company. I think there's better opportunities in the payment space than Fiserv, and I want to see what the new CEO is going to do before I would consider buying it again. At least that's my opinion.
So maybe to try to oversimplify at the risk of completely butchering all this fine discussion we've had, sir, buying a value opportunity, but it's a loser in a good industry, maybe not a great value opportunity.
Sometimes, I think we've probably talked about this before, but sometimes the market is right, and they see something going wrong and they punish the company justifiably, and this may be that case. And based on the information that we have today, I think that's probably the case, but time will tell whether that's true or not. And that's part of the fun of investing, right? Is like, some people out there could listen, Dave's wrong, and they could take a big swipe and do awesome. All right, more power to you. Great.
Right.
And I'll be happy for you and clap and move along. But I think, I guess that's kind of how I think about it.
Yeah, I think that's well said.
All right. So you mentioned the whole restaurant business thing. Maybe we could segue into that. You want to talk a little bit about Chipotle?
Yeah. I didn't follow it super closely. Do you remember how much it was down actually after earnings? I think it was around 25%. It definitely took a haircut.
Yeah, I believe that's what it was as well.
Yeah. And seeing like a drop like Fiserv's and seeing a drop like Chipotle kind of prompted this discussion we're having, because it's common for stocks to crash during earnings releases, but the scale and scope of it seems to be intensifying, at least from an outsider view. We're long-term investors. We try to not get too involved in the daily as much as we can, because that can make you make emotional decisions. but at the same time, 25% drop in a day after earnings is significant. So in the case of Chipotle, pulling them up on fiscal and looking at the transcript for Q3, one of the big concerns was the low to middle income guests, which is household income below 100,000 a year, represents about 40% of their sales. That demographic plus the 25 to 35-year-old age group are both dining out less often. And they are shifting their spend, according to the company, on groceries and food at home rather than competitors. So, that's management's way of saying like, hey, maybe these are outside forces. It's not that the Chipotle brand is bad, it's that we have a different economic environment. So you can kind of choose whether to believe them on that or not. And the other comment that was made is there are headwinds like unemployment, student loan repayments, and slower real wage growth. So real wage being inflation adjusted wage growth. All of those things. And then Wall Street did not like to hear that. Some of the numbers based off of that, I mean, revenue was up 7.5%, but comp sales were only up 0.3%, and the guidance was low single digit range for the rest of the year. I'm sorry. They guided for a decline in the low single digit range for the rest of the year. And they're also talking about higher labor costs and that contributing to lower profits. So you do have these short-term profit pinches that's happening on top of the fact that their core demographic is not spending like they usually do.
So if you had to, I mean, none of that is great news, right?
Yeah.
So here's my question. If you look across the restaurant industry, I guess the pushback that I would have on what some of the things they're saying is I don't necessarily are we seeing that in other restaurants?
Mm-hmm.
Like, are you seeing this same kind of impact at a McDonald's? Are you seeing this same kind of impact at a Texas Roadhouse? Now, granted, those are not apples to apples categories of restaurants, but is Cava? Now, Cava is what you could say is a direct competitor. Are they seeing the same impacts that Chipotle is? And that would be the first question that I would ask myself. I'm not saying you know the answer, but that is certainly a question that I would ask myself.
Yeah, for McDonald's, comp sales up 3.5%, global comp sales. And then their guidance, it looks like they didn't have to revise guidance. So they expected a little bit of acceleration in Q4 of comparable sales. So they're not knocking it out of the park, but they're not seeing the same decline that Chipotle is. Right. That's just for McDonald's. I couldn't tell you about some of the other ones, but I think right. McDonald's is a decent company to compare to. Yeah.
Yeah. Yeah. So that would be my first, if I was thinking about Chipotle and what happened to them, why, they're listing off a lot of reasons, which sound to me like they're deflecting, like this isn't us. It's not us and it's not our fault, but they're, blaming it on outside forces. And one of the ones that I talked to some of the guys in our pitch teams, Tyler and the gang, and I brought up this point about beef prices. When these type of restaurants aren't buying at market prices today, they usually have long-term contracts with their vendors because poultry, meat, fish, vegetables, a lot of that stuff can be so volatile that they will work out longer-term contracts to stabilize the prices. So they'll buy beef at this price, they'll buy ground beef at this price, they'll buy chicken at this price, and it's set for a period of time. And the reason why they do that is their the vendor, the people making the chicken, they want to know that they can get a good price if the price drops, and likewise they'll eat the loss on the profit, knowing that they made a gain on the other end. And the restaurant knows that they have a steady price, so that when they go to price their menu, they know how much they're going to charge for that. And so when Chipotle says that our profits are being impinged by the prices of beef, I kind of call BS on that, because that to me I feel like that's kind of a lame excuse, because I'm going to be harsh here for a second, but it feels like a lame excuse, because there's no way in heck that Chipotle is buying beef at today's prices. They're buying it at 6 months ago prices. Will they have to negotiate higher prices in the future? Probably. But when they do that, then they can set their menu according to those prices at that time. And so especially a big protein item like that, that's something they're going to know what the price is on that, and they're going to set their menu prices accordingly from there, because they're not changing the menu prices daily. And so to me, that's kind of a lame excuse.
Yeah, I have no comment on that. That makes sense to me for sure. I wish we could look at Chick-fil-A's financials.
Oh yeah,
because this is very Andrew specific. But if I think of like who would be the closest restaurant that would take away a normal Chipotle order for somebody like me, like Chipotle, and everybody probably goes to Chipotle for a different reason, but I'm kind of like a super fan. So I like to go because you get a lot of protein at a cheap price and you get it quick. Chick-fil-A is really the only like fast food that has something comparable to that. However, Chick-fil-A is not public, so we can't see how their Q3 was.
Right.
So I just wish we could see it. But
yeah,
too bad.
for sure. Yeah, too bad. Do you think there's been some chatter about the portion sizes? Over the last, probably since the company first came out, but it seems like it's gotten louder more recently. Do you think any of this is pushing back on the narrative around Chipotle? Like maybe not necessarily. I think it probably could. It would definitely show up in the numbers. But do you feel like maybe just generally that people are like, yeah, I'll go to Chipotle, but I don't. Maybe they're choosing to go somewhere else because they feel like they're not getting the same value that they would normally?
I think it's entirely possible. I also think it's a thing of opinion.
Yeah.
So like where would you go instead? Like where would you get more chicken?
Right. Yeah, I don't have an answer for that.
Yeah,
for sure.
I don't either.
Yeah, I know that there was an analyst from Wells Fargo that went to 100 restaurants and measured the portion sizes of all the bowls, like just weighed them, ordered the exact same thing and weighed them, and it was all across the board. So I know that one of the things that the new CEO is trying to work on is the operations of the business to make sure that is more consistent across the brand. I think that will certainly help. But yeah, so maybe we could talk a little bit about the core customer and what they're talking about with the decline in sales, because people are opting. Like, this is one of the things that always makes it hard for me to think about, like, the whole economic question, because you hear commentary from Chipotle about this customer is struggling, but then you see other information from Visa and MasterCard where you see that more people are using their cards and they're spending more on their cards. And so that it's like conflicting information. So you don't know which one is right. And so I guess, how do you think about that? And maybe how should investors think about that?
I think it's a great question and something you probably have to constantly try to evaluate. And that's what makes investing hard. And that's why people get paid the big bucks to do it full time. One thing I will throw out there, because I saw it today as a headline, this was reported by Reuters, and it said, this was today, November 6th, which is when we're recording. It said U.S. layoffs for October surged to a 2-decade high. Basically, U.S. employers cut more than 150,000 jobs in October, which was the biggest reduction for the month in more than 20 years. I don't know if that means biggest reduction in a month or was that the biggest reduction in October in 20 years. That was according to Reuters. They said it was a report by Challenger Gray and Christmas. So whatever, it being a weird time because the government shut down, you can't get the official data you normally can. It just makes me wonder what the heck is going on in this economy. But to your point about the whole Visa MasterCard thing, how are they doing so strong when it feels like companies that are more discretionary left and right are kind of like, it's like left and right. They're just like falling ducks, a lot of these once prosperous brands. So yeah, it's very weird.
Mm-hmm. Yeah, it's a lot to try to work through and try to figure out what works best for now. So if somebody was looking at a company like Chipotle, what are a couple of numbers maybe they could look at that would give them some indication that maybe things aren't going well, and what could they look for when things maybe are doing better?
Yeah, that's a great question. So we've talked before about restaurants. We'll use the KPI again. You don't have to reinvent the wheel. It's comparable same store sales, comp sales, same store sales. So you want to look not just at what happened Q3 2025, but you look over as long of a period as you can. Look at previous recessions, look at previous downturns for the company. Look at it when it was the whole E. coli scare that they had to work through. So look at that long term, compare it to other restaurants that you think are comparable and would give you good insight into the economy. And then I would also say, in the case of Chipotle, part of the growth story is the fact that they are their goal is to double the number of restaurants. So check to see, is that TAM still achievable? And then what does that TAM mean for growth? If we're talking about doubling restaurants over 10 years versus doubling it over 50 years, it's going to be a different growth rate number. So checking all of those things. And then for me, just being really DCF valuation focused, how does that compare? Once I have that growth rate in mind, how does that compare to where the stock is trading? Those are some good metrics, but at the end of the day, yeah, you do need to decide if you're going to be a long-term part-time business owner of Chipotle. You have to decide what you think about the moat and how strong the moat is now and how strong it'll be in 10 years. And that does play a big role.
Those are great points and great numbers for people to use as a guidepost to see, okay, if I'm looking at this company, any restaurant, those are great numbers to look at.
Yeah.
Yeah, for sure. All right, let's move off of restaurants and talk about a company we've never talked about before, Duolingo. So this is the ticker is DUOL, trades on the NASDAQ. And for those unfamiliar with the little green owl, this is the learning language app. Dave was a big fan of this. I used this for almost 5 years to try to learn Portuguese. And I think my streak got up to 1,600 days in a row or something crazy like that.
Dang.
Yeah. Before I finally was like, okay, I'd actually reached the point where it was just repeating lessons because there was no new information it was going to provide me. So I canceled. So I'm maybe not the perfect user, but yeah, I was a big fan. So what happened to them?
I don't know. The stock is down though. A couple of metrics I'll just point out that I think are interesting. The trailing 12 months price to earnings ratio, PE, is down to a 35. I think that's very interesting. That means they are now profitable, and they have not been for a while. So that's really interesting. 3-year growth rate of 34.7%, call it 35% a year. So, I mean, in the last 3 years, they've grown a lot from revenue perspective. They are profitable now, and it doesn't seem like it's a crazy valuation like it was in the past. So it is interesting. I don't know what their ROIC is, and I want to check.
It's evolved from 2020, which was a negative 44%, to the last 12 months is 27.2%. According
That's
to
a great number.
Yeah, it is. Yeah, that's a really, really good number.
I pull up their shares outstanding because I want to see, are they still like heavily diluting? They did dilute a lot in 2020 to 2021, definitely in that ultra high growth phase. But if you look at the last 3 years, they're diluting about 5% a year. So still getting outside financing to grow. But you wonder if that starts to slow now that they have such high profitability.
Mm-hmm. Yeah, so it's interesting because this one, it looks like this is the reason for their drop is different. The other two companies we were talking about have not been performing financially, and their guidance was not great. Whereas even when you look at what's going on with Duolingo, out of the gate, you can see that they even the AI summary, the Duo strong third quarter metrics performance marked by solid metrics across the board is primarily driven by a pivot. So even the AI is saying they had a good quarter financially. And if you look at their numbers, their daily active users or DAOs exceeded 50 million. Their full year booking guidance nearly 1.2 billion. Their adjusted EBITDA margin, 29%. So across the board, it looks like they had a great quarter. I think it probably has to do more with their guidance. So they're guiding for, I guess, they're guiding the full year projected bookings to reach 1.2 billion, which is 33% up year over year. And I mean, that looks really good to me. I wonder if this is more of an AI scare. I know that I've seen people talking about Duolingo struggling because, not struggling, but worried. Investors were worried about AI's impact on them.
And also finishing that thought about the strategic pivot, they are making significant investments in AI. So interesting that
people are afraid of AI.
Right. Well, if you're Adobe and you invest in AI, people hate it. If you are NVIDIA and you invest in AI, people love it. And they'll just like jump to the moon because they're so happy that you're investing so heavily in AI. So it really is a weird thing. I mean, if I was a shareholder, it would be tough because they don't really have a capital allocation track record per se. Like it's hard. Like I think of like Airbnb or Etsy, where you had these young growth companies that started reaching profitability and then had to make big capital allocation decisions. So when you're an investor in that situation, you don't know if management's going to do a good or bad job for that when that hasn't been a thing yet. When you're a ultra growth mode young company, you're just trying to scale revenues as fast as you can. It becomes a different story when you start talking about capital allocation and seeing your core business kind of mature. And so I wonder if some of that's playing into it. Like, are they going to go the Mark Zuckerberg down the Reality Labs rabbit hole with their capital allocation into AI? Or is it going to be more muted? And then to your point about just the AI threat, are people going to use ChatGPT to learn a language instead of Duolingo? Those are all questions that are really hard to answer because you don't have a historical track record to be able to evaluate on. You kind of are essentially betting on the people and betting on faith, or betting on the platform, or betting on the customer love of the platform. Those things are there's a lot less evidence to those than something like a company that's been around for 10 years and the CEO has a good track record kind of thing.
A lot of the stuff that you have to base your evaluation on is a lot squishier. Like there's not, it's harder to put numbers behind a lot of those things that you were just mentioning. And so it makes it to your point, it feels a little bit more like you got to take it on faith that the people running the business are going to do what they say they're going to do, and they're going to do what's best for the business in the long run. And to your point about Reality Labs, that was a big unhinge for Meta for a while until Zuckerberg, got the hint that you needed to be the year of efficiency. And, now look at the company. So yeah, and with such a short operating history as a public company, there's not a lot of evidence to base it on other than listening to earnings calls and maybe seeing interviews with the CEO and other people in management and seeing other people use the app. I mean, I was a big user. My wife didn't use it at all. Did you use it?
I used it enough where it became such a chore that I hated to see that little guy. Like, he was always getting so mad by the end of the day. And I was like, I'm trying to relax. I'm trying to sit on the couch. I'm trying to watch YouTube. And you are just giving me the evil eye and telling me that I'm not done with my workday. So,
Right.
yes. But like, I think something that kind of would be fun to talk about, like, do you buy the whole AI is going to knock out a bunch of apps narrative? Like a Duolingo, I think, is a great example of like a super niche app. Like,
right. So this is my experience, and people can take it for whatever it's worth. So like I said, like I mentioned before we started talking about Duolingo, I was an avid user of the app for a very long time. Once I stopped using it, about a year ago or so, I tried figuring out maybe some ways occasionally, whether it's ChatGPT or Gemini or something, that I could use the AI platforms as they are as a way to try to continue learning the language. And while it can be helpful to like do something like, let's say flashcards to learn vocabulary or to answer questions or to read, they could be helpful. But one of the things that I always felt like Duolingo does a really good job of is just easy. It's easy to use. It's easy to access. The reminders that you hated so much. I looked at them as gentle nudges to get off my butt and do it. The little side eye look that the owl gives you kind of thing. Anyway, it just, they gamified it, right? And they made it a lot easier to utilize and use. Whereas with the going on your laptop and trying, then you have to type in what you want to do. Then you have to go through the effort of doing it, which, okay, fine, you're going to do the effort anyway on the Duolingo app. But the disconnect is that you can do the Duolingo app, on an airplane. You can do it at, a grocery store. Whereas if you want, if you have 10 minutes and you want to learn something while you're standing in line at the DMV, it's harder to do on the app, an AI app. If you go on the ChatGPT app, yes, you can do that, but it's also it's a little harder in that you have to initiate what it's going to do for you. Whereas the Duolingo app is you literally open the app and you got a lesson right there and boom, off you go. Whereas with Gemini or something, you got to type in, okay, help me learn these verbs in Portuguese. I need to do the conjugations in this tense and this tense and this tense. And okay, fine. And it'll do all that for you. But it's not as user-friendly. It's not convenient. And I feel like the Duolingo app in particular is and was very convenient.
I almost see them as a category of one. Like, who is the alternative to Duolingo? Right. I'm sure they're out there, but I don't think there's one that's well known. So if it's a category one, it's a category one for a reason. Right. And if they teach the language the best compared to any other option, then that's really hard to replicate, because that's literally that's their whole thing. They work all day long trying to make that better and easier for people. One thing I will share, which I don't know how this showed up in my algorithm. Just don't ask about my algorithm. It's just things just appear on there. But it's a video by Tim Gabe, called The Secret Behind Weirdly Addictive Apps. And so there were a couple other apps on there, Duolingo being one of them. And he broke down like all the little details of like from the onboarding process to how they do an animation and they do a little sound effect and they like all these small little things that they've perfected over lots of iteration, a lot of good engineering, and how it really enhances that user experience. And to your point, everything you're saying about it being engaging, it's fun, like you want to do it, you come back and you get those quick wins. All of those things are all carefully thought out. And it's not something that you and I could just manufacture through a vibe coding thing. Like they've really done their work on it. So I think that's a cool video. Maybe you find it interesting, you go check it out. But yeah, there is something to Duolingo where I think it's just being a casual user. I never learned the language from it, but I enjoyed my time on it, and I can see the social nature of it. I can see the addictiveness of it, and the fact that it just kind of helps you learn a skill. It's hard to definitively say, hey, this is an alternative to it, and that matters when you talk about investing. At the end of the day, it doesn't answer all the questions we had earlier, but it does say something about, if it's something you have conviction on. I think they're all factors to think about.
Very well said. Very well said. To me, I guess, do you feel like the AI threat is overblown?
That's a hard question.
Mm.
I think in some areas, yes, but I think in other areas, no. And I'll go back to that Reuters article that we just pulled up. I think it's very clear that AI is already knocking out jobs and making things so efficient that people are getting laid off. So fears around that overblown? I don't think so. We're already seeing evidence of the fact that those fears are valid. As far as other businesses and other industries, I really think you have to take it case by case.
I'd agree. To your point earlier, it said Duolingo talks very upfront about the fact that they're using AI to make their business better. And so while people are afraid of AI competition, Duolingo also, you got to think that the people running the company, they're not idiots, and they see all the things around them, and they're using AI to try to make their business better. And Adobe is doing the same thing, but they're also being penalized because people think that AI is going to harm their business. And time will tell whether in either case is right. But the other side of the equation, like you said earlier, is that NVIDIA is using AI to make their business better, and they're being lauded for it. So sometimes the market is a little bit schizophrenic about what to me in the long run. If we're going to focus on Duolingo, my gut tells me that it's more noise than real substance in this circumstance. But as always, time will tell. All right, folks. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our little back and forth on some of these companies and why the market is reacting so strongly to some of these results. And hopefully you learned a thing or two that can help you analyze and assess what's going on with a company when you open your app, your stock market app, and you see a company is down 25%. And maybe we can help you avoid panicking and selling immediately. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.